Hello, everybody. This is Colin Murphy here. Welcome to podcast 28. It's been 3 weeks since my last podcast, which is actually a significant improvement, as a lot of you will know. The feedback from the last one on balancing cash flow and capital growth is really positive, so thank you for that. I appreciate it. Today, I'm going to spend a bit of time talking about why I invest in Tampa, Florida, and why I buy the property types I do. However, I think the criteria I use when I'm selecting neighborhoods and selecting property types in my local market can be applied anywhere at all in any market. I had a quick look at my podcast stats this morning, and apparently I've got listeners in more than 50 countries, including hundreds a month from places like Canada, United Kingdom, Ireland, Spain, Germany, Hong Kong, and Australia. So there you go. Big shout out to my overseas friends. So, like I was saying, I buy a lot of rentals in Tampa, Florida, and lots of people who don't live anywhere near Tampa, Florida buy homes here too because it's a great market. But the content in this podcast can be applied to your home markets too, okay? So, before I get started, if you're listening for the first time or if you've just tuned into one or two podcasts, let me tell you a little bit about myself. I'm Colin Murphy. I'm a full-time real estate investor. I've been buying US property, mostly Florida property, for the last 10 years. And for another 4 or 5 years before that, I was involved in overseas real estate. So I've been in real estate since around 2003 or 4. And at the moment, I own a business with a couple of friends where we buy single and multifamily houses all over the Tampa Bay area. We buy them, we renovate them, we keep some of them, we sell a lot of them to overseas investors. We buy 2 or 3 houses a week. That's generally what I do. I try and buy 3 houses every week. Bought 3 last week, and it's Tuesday. I've got one so far this week, and I'm hoping to get another 2 by Friday. Okay, so that's what we do. We do so about 120, 130 houses a year. So we're getting busy. I have a good bit of experience working with out of state and international investors. I don't get too involved in selling houses to owner occupiers, for example, or retirees or vacation home owners. The houses that we do sell after we renovate them are mostly sold to investors that are looking to build rental portfolios here in Tampa. All right. So that's what I do. The company's called Torcana, Torcana, and you can find out a bit more about us on torcana.com. But enough about me and Torcana. So, why do I invest in Florida? And like I say, the reasons I pick Florida and Tampa and the property types can easily be applied to other markets. But I don't invest in Florida because of the beaches and the sunshine and the sunsets. That's very nice side effects of living here. But the reason I invest in Florida is mostly because the population growth is double the US average. And when you're investing in places which have a fast growing population, it makes a lot of things a lot easier. And you can get away with a lot more mistakes, frankly, as well, as I have over the years. And anybody that's bought hundreds of properties has gotten away with lots of mistakes. So, when you've got a fast growing population, it naturally increases demand. Okay, and that's demand for rental properties, which will increase the amount you can rent it for. It increases demand for buying properties, which will increase the value of the homes. So it's great for increasing rental amounts, and it's great for price appreciation. And we've been seeing plenty of both here in Florida. I'm also investing in Florida because it's got a very low unemployment rate, as does a lot of this, a lot of the US, to be honest with you. But job growth in Florida has been phenomenal. It's consistently been one of the best job creators in the country over the last 10 years. It's just a magnet for jobs. I also like it because it's the only state east of the Mississippi which doesn't have a state income tax, so that's an extra tax you have to pay in a lot of states in addition to the federal taxes that you don't have to pay in Florida, and you don't have to pay it, I think, in 6 other states as well. Florida's also got low property taxes, so that's another overhead which is reasonable in Florida compared to some other places. Also, just as importantly, Florida is what I would call a landlord friendly state. So it's not like California or New York where if a tenant decides to dig their heels in and not pay you any rent, it can be extremely difficult to resolve that situation. In Florida, it's extremely easy. On the very rare occasions where, we have to deal legally with a tenant to get them out or get them to pay. It's been very straightforward and very quick. So I like that about Florida a lot. Population growth, job growth, no state income tax, low property taxes, landlord friendly. But within Florida, I'm almost exclusively buying in Tampa. Not because Tampa is the only city in the world worth buying in, because I live here, I like living here, and it just happens to be a great city for real estate. The population in Tampa, getting back to population, grew almost 30% since the year 2000. That's an enormous rate of growth. Tampa's changed dramatically since I started coming here in the early 2000s. Also, the house prices are 27% below the US average. So kind of think about that triangle where you have a fast growing population, you've got lots of jobs, and you've got affordable houses. It's a virtuous circle, because you're not going to be, if you've got a great job market and you can buy a really nice house, that's the place young people want to go. I mean, Florida's often kind of pigeonholed as being a great destination for retirees, and it is for sure, always will be. But more importantly, for anybody looking to invest in a place like this, it's a top relocation destination for professionals. There's thousands of people moving here every week from expensive cities in the Northeast, in Washington, Boston, New York, all around there. Tampa is one of the top 20 MSAs, metropolitan areas in the country, so it's a big economy. It's not a small market. It's much, much bigger than Orlando and Jacksonville, for example. I like it also because the diversity of the economy is very good, and that's very important. It's got a very good healthcare system. It's got a great education system. Infrastructure is very, very good. Whether that's the road, you're not getting traffic jams here. Like, I was in LA and the Bay Area a couple of weeks ago. Oh my God, the traffic there is just awful. And I mean, I was avoiding traveling anywhere during peak times anyway, but I don't know how people, get around in those areas and commute to work. It's just a nightmare trying to drive anywhere. Tampa's it's far easier. The traffic isn't that bad here. It's got a really important ports here. MacDill Air Force Base is here. U.S. Central Command is here. Coast Guard headquarters are here. It's got, I think, the seventh most important commercial port as well. So yeah, a lot going on, but mostly I love is because, again, population growth, job growth, housing affordability. That's the trifecta there, and Tampa's like $130 billion economy, and no one sector has got more than like 15% of it. You've like tourism is about 11%, education and health is about 15%, professional and business services about 18%, retail is about 13%, government's about 12%. So it's a very diverse economy. It's not dependent on any one sector, and that you should be looking for that where you want to invest as well. Try and invest somewhere that's diverse, that you're not dependent on any one sector, and God forbid any one company. You don't want to be investing in a small town where if one company decides to shut down, some sort of plant, suddenly the rental demand dries up. You wanna try and avoid that. A bit more about Florida real estate. Cash buyers are about a quarter of total buyers over here, and that's been kind of pretty consistent. Over the last 7 or 8 years with the properties I've been selling, maybe 3/4 are finance buyers, 1/4 are cash buyers. It's pretty normal. Inventory is very low in Florida. That's also a positive. If you can find really good deals consistently, having low inventory is good because it makes them easier to sell. If you can still find properties in a seller's market, you're going to do pretty well. So Florida's got like a 4 month or 3.5 month supply, which is kind of below equilibrium. Florida's like a pretty traditional market now. It's not that distressed at all. I remember back in 2011 and 2012, like 40 or 45% of all transactions were either foreclosures or short sales or REOs, like distressed kind of bank sales. Nowadays, that's 5% of the market, and 95% is just one owner selling to another owner, basically. So it's changed a lot. It's changed a lot. It was totally different 5 or 6 years ago. It's much more of a normal market now. And, because of that, and because prices have been increasing pretty nicely over the last 5 or 6 years in Tampa and in lots of other markets, it might be easy to think, I'm too late to the party. Um, should have invested 5 years ago. Should have been buying real estate 6 years ago. I'm too late. I've missed the boat. I've missed my chance to build a portfolio. I mean, that's not true at all. I mean, yeah, fair enough. If you had bought stuff 5 or 6 years ago, that's fine. You'd be doing very well for yourself. But I think Tampa and lots of other markets have one of the strongest real estate profiles in decades. And let me kind of drill in to why. And this is actually, I'm kind of talking more about macro rather than specific markets here. Don't forget that lending criteria continues to be extremely strict for the majority of Americans. It is much more difficult now to get a mortgage compared to what it was 20 years ago. I'm not talking about 10 years ago when mortgages were given to anybody at all with a pulse that was over 18. I'm not talking about that. That was nuts. I'm talking about 20 years ago when the market was normal. I mean, nowadays, unless you've got a really good credit score, in the high sixes, low sevens, unless you've got a very steady employment record, very steady credit record, it's very difficult to get a mortgage. I mean, you're kind of either in the club and you've been enjoying really good interest rates for a long time. But if you're out of the club, and that includes a lot of dependable, hardworking people that just can't qualify for a mortgage because they're not meeting the lending criteria, which is much stricter than it used to be, then you're just excluded from being a homeowner, and you're certainly excluded from being a landlord. So, if you can't get a mortgage and you're either too old or you don't want to live with your parents, what are you going to do? You're going to rent. I mean, if you can't buy a house, you're going to have to rent a house. That's the truth for a lot of people, and that uh, obviously boosts rental demand. I mean, we're seeing that in the statistics. There are far more renters as a percentage of the population than there were 10 years ago, 20 years ago, 30 years ago. So it naturally boosts demand. Also, you have a lot of people that just don't want to buy a house, even if they could get a mortgage. They just don't want to do it. Millennials are a famous kind of case in point. They're these kind of younger generations, basically in their 20s and early 30s. They're not buying houses compared to previous generations. Their parents might have been buying houses in their late 20s, and millennials might be in their late 40s or even, late 30s or even early 40s. They prefer to remain mobile in case they need to, because they're moving jobs, lots of exciting jobs in different places. So they want to remain mobile. They might want to live in, you know, urban city center areas where they can just kind of visit all their bars and shops and restaurants within walking distance. They don't like the idea of living in the suburbs. I've even got retirees that are renting properties from me that are renters by choice, that they've sold their homes and started renting by choice because they just didn't want to deal with roofs and ACs and water heaters, number one, but also because they got a bit burned during the crash and they didn't want to be a homeowner anymore. They prefer to be renting and let someone else worry about the housing market. They're just happy to pay $1,000 a month or $1,100 a month for a nice house, and they've got a good, it's got some good savings because of the house that they did sell after they paid off their mortgage. So, when you have that mixture of people that can't get a mortgage that have to rent, when you have a lot of people that are choosing to rent, and when you have low inventory, that's all ticking the correct boxes for any landlord. I mean, basically, if the demographics are in your favor, there's more and more renters. Population is growing fast, first of all, and more people than not prefer to rent or have to rent. So rental demand is naturally increasing and increasing a lot. Like 80% of new households are renters. So somebody gets together, whether it's a couple of friends or boyfriend and girlfriend or husband and wife, they get together, they form a household. The majority of them are renters for the first 5, 6 years, maybe more of building that household. So it's there's never been a better time to be a landlord because there's just so many people that want to rent a property. Okay, and so that's great for one thing, but one of the reasons I like the areas in Tampa that I buy in is because they're so stable. They've got this great foundation of cash buyers and owner occupiers with very low debt. So the last 7 or 8 years, a lot of people that have been buying up there, people like me basically, were buying with cash, fixing them up, renting them out, And before that, these are kind of homes that were built in the 70s for the most part, early 80s. The people that live there, the owner occupiers, they've mostly paid off their mortgage. So you didn't have, there's been very little debt put on these neighborhoods in the last 7 or 8 years. Other neighborhoods, like more upper middle class neighborhoods, have had like waves of first time buyers and people trading up that have been putting finance in these areas. So there's lots of areas in Tampa and other cities where there's loads of debt has been added to the housing market in the last 10 years. The areas I'm targeting have very little debt. They're very stable, and for me that's good because it makes them that bit more resilient to any wobbles or any shocks in the stock market or interest rates or anything else. If you're kind of owning, if you're a landlord in areas where there's high rental demand and there's very low debt because the owner occupiers have paid off their debt, and there's so many landlords that have very little debt in there, you're very stable. You've got a very, you're not going to be the first to wobble at all. There's going to be most of the other market segments, further up the food chain and further down the food chain, are going to feel any shakes before you do. So that's one of the reasons I buy in these specific types of neighborhoods, which I'll drill into in a minute. So kind of despite the strong appreciation we've had in places like Tampa and lots of other cities in the last 6-7 years, it's Tampa's at a different point in the recovery curve than places like Denver, for example, which is kind of peaked, or Miami, which is kind of peaked. Tampa, importantly, is affordable, and there's lots of room for price increases because there's not a lot of debt in there. First time buyers are only starting to come into certain kind of lower middle class neighborhoods, which is going to give you an additional kind of wave of price growth for me. And these macro figures are just all working in our favor. It's a very, if you can qualify for finance, or if you're lucky enough to have lots of cash, it's a very easy time to be a successful landlord. If you can get yourself a good house that's well renovated, and obviously a good manager that'll place a good tenant, it's a very easy time to place to be a landlord, because there's just so much demand. Population's growing, there's lots of jobs, lots of demand for rents. It's a very easy time. Prices are increasing. So, what kind of properties do I target? I mean, mostly single family homes, which are 1,000 to 1,400 square feet, which have open plan living areas, an attached garage, small front yard, slightly bigger backyard, after repair values of about $100,000 to $150,000, and rents from about $1,000 to $1,400. That's what I target. 12 to 1,300 square feet, $120,000, $130,000, rents of $1,100, $1,200. That's my bread and butter. Those are the properties that are very kind of safe, reliable, profitable, easy to rent. These are like low crime, lower middle class areas, which, very importantly, tune into this, they've got about 2/3 owner occupiers in them. So it might sound a little counterintuitive, but if you wanna, the best rental property locations for me are in the areas where you've got lots of owner occupiers. All right, the best rental locations are places with lots of owner occupiers. I don't want to be expanding my rental portfolio in places where it's just all renters. It's just multifamily apartment blocks. I don't want to do it. I want to invest where owner occupiers are living, because they increase the quality of how the area looks. For starters, they take care of their properties a little better, which encourages other people to do the same. And I don't want, if I ever needed to sell some properties, I don't want to be stuck having to sell them only to an investor. I want to have an exit strategy where I can sell to an owner occupier. That they're always going to pay you more money than an investor, because they're investing for they're buying for different reasons than an investor is. Okay, so bear that in mind. Make sure you look at the stats for how many owner occupiers are in your zip code. You can get it with city-data.com. Type in the zip code, that'll give you a bunch of stats, and one of them is percentage of owner occupiers. I also avoid waterfront areas and flood zone areas. Obviously living on the water is great. It's nice to wake up and look at a water view. That's beautiful. Everybody wants to see that, and a lot of the most expensive properties on the East Coast and the West Coast are in front of the water, but in terms of being a landlord, you wanna avoid those. Avoid anything close to water. Basically, it just complicates your insurance. It complicates risks. So I don't do it. Our properties are like 6 miles inland in elevated locations. So I don't avoid. I avoid water locations completely. I buy them properties I buy a lot of properties in the foreclosure auctions, some in private auctions like Hubzu or Zome.com or auction.com. We buy a good few from wholesalers, local wholesalers, so they might put a property under contract with a homeowner or out of state landlord or something like that, and then they'll either assign the contract to me or they'll buy it as is and then sell it to me and then I'll renovate it. So we do a lot of work with wholesalers. I keep an eye on the MLS as well. I always submit a few offers every week for properties that are listed for sale, particularly the ones that need a lot of renovation or the ones that are difficult to insure or that might have, problem tenants inside or some sort of, pest control issues that are easy to resolve with a few $100. Just stuff that's not very homeowner ready. I like buying that stuff because it's, I have crews that can get to work and make them look as good as new in 4 or 5 weeks. So we kind of renovate properties to a slightly higher than average standard. I don't want to over renovate them, but we're generally putting on new roofs and ACs and updating floors and kitchens and bathrooms, putting in a privacy fence, things like that. So we kind of have these standardized templates now, so our guys know what vanities to put in, what cabinets, what countertops, what paint colors to use. It makes it a lot easier to repeat. I generally have about 18 to 20 renovations going on at any one time. So as you can imagine, you want to try and standardize that as much as possible and reduce the amount of daily decisions you need to make as much as possible. So, ideally you're just going to walk through a house with your general contractor, once or twice, and once just to confirm your scope of work and twice just to double check the work and point out any fixes that need to be made. So, I would recommend that people focus on kind of B areas or C plus areas. I focus on what I would consider to be A and B areas in my neighborhoods. I mean, they're lower middle class neighborhoods, but I'm buying in the A and B areas within them. That $120,000 to $160,000 range gets you a very good quality property in the kind of Tampa neighborhoods I buy in. Basically, if the rent is more than $1,000 a month, you're getting a good quality tenant. You're avoiding the lower income, Section 8 tenants, which can give more maintenance and vacancy headaches. I want to rent to people that have full-time jobs, that have lives that are reasonably organized, that have incomes of at least, $50,000 a year, that have very clean records, no criminal history whatsoever, no evictions, no just a clean record of holding down a job and paying their bills on time. That's what I want, and a good property manager will have no problem vetting tenants to make sure that happens. So try and do that as well. Because if you're looking at areas, if you're looking at lower income areas, you're going to give yourself a lot of extra problems. I mean, if you're a local landlord and you have a lot of time to dedicate to it, it's definitely a viable model. And also, sometimes it might be tempting to buy the nicer properties beside the good school districts with the newer builds and the vaulted ceilings and maybe the swimming pools. But, be careful about that as well, because, a $250,000 property certainly has twice the running costs of a $125,000 property, but you're not getting twice the income. So the cash flow suffers the further up the ladder you go. So for me, you only go up the ladder far enough to avoid the problems that come in the lower rungs. That's my strategy. It's not very complicated. You just go far enough up so that you're avoiding the problem tenants, and then you stay there. Because if you go too far up, your cash flow is just going to suffer a lot, and you're not really getting that much extra value for money. It's not like a $300,000 house appreciates a lot faster than a $150,000 house either. In my experience, it doesn't. But I'll tell you, if there ever is a market correction, and if you're owning properties 15, 20, 30 years, you're going to see a few market corrections. You don't want to be at the top of the ladder, because there's always going to be people that are dropping down in a recession. And for me, if I'm renting a property for $1,100 a month, I mean, sure, some of the tenants in a crash might leave because they can only afford $700 a month now instead of 1,100. But also, the people that are renting for $1,500 or $2,000 or $2,200 in the fancy luxury communities, they're going to leave those too, and they're going to come down to 1,100. So there's always demand in the middle. You don't want to be at either extreme. If you can get yourself in the middle where you have that, there's always going to be rental demand, or there's always going to be resale demand. There's always, like in Tampa and in every other market, there's always going to be demand for lower middle class houses. Always. It's a lot easier to sell them. They've got bigger catchment areas. There's more people that can and want to buy $140,000 house than a $340,000 house. That's just the way the world works. So if you want to make your life easy, target those kinds of properties. Okay. What else? Yeah, and just try and renovate them to a slightly than average standard. Don't go too far ahead, but if you have a nicely renovated property, if you've better than average quality properties, you're going to get better than average quality tenants. I come across landlords all the time. They're kind of slum landlords, and there's just loads of deferred maintenance. Their houses are a mess. I mean, they're a disgrace in some cases. I mean, what kinds of tenants do you think rent those? Do you think they're going to be reliable tenants, paying their bills on time, sticking around for 3-4 years? I mean, forget about it. I mean, if they're in any way organized, they'll move on to something better. And if they're not organized, you're going to have to evict them, and it's just going to be a mess. So just try and rent out, try and have a clean house and rent it out to good quality tenants, and then just treat them with respect and answer their questions, and have clear lines of communication, and fix stuff when it needs to be fixed. Get yourself a home warranty so that you're not giving out about every single little repair bill, and you'll do just fine. Yeah, so that's my thoughts. So let me kind of conclude some of those. If you want to make investing in real estate a little bit easier and a little bit more profitable, try and find places with some of these characteristics, and I'll list them out for you. So, fast growing population and a strong job market. There's loads of markets that are like that right now. Try and find somewhere that's landlord friendly. Okay, and if they've got reasonable property taxes, all the better. But that's not a deal breaker. But landlord friendly, fast growing population, strong job market, they're good. Invest in an economy that's reasonably big and diverse. I'm not a big fan of investing in little villages and one horse towns. There's just one or two things can go wrong. They can be too dependent on any one industry or company. I just don't like doing it. It can be very profitable for a long time until it's not. I prefer to invest in local economies that are reasonably big, like more than 1 million people, and that they have that diversity and they have their own momentum. They're not depending on anybody else. After that, then drill down further, try and buy neighborhoods with lots of owner occupiers and lots of first-time buyers. They make very stable. They're the neighborhoods where you get the stable, easy renters that stick around for years, where there's lots of owner occupiers. Try and make sure that there's like more than half the residents are owner occupiers, and you can look on city-data.com for that. Look for the lower middle class homes. They've got rental and resale demand in every cycle. Okay, real estate's got cycles. Goes up and down, goes up and down, goes up and down. Happens all the time, every 20 years, every 25 years, sometimes longer, sometimes shorter. But if you're look for the lower middle class homes. They're the most resilient for market cycles. That's why I buy them there. Also avoid unique or really special houses. I mean, pick stuff. I mean, buy yourself a unique house to live in. Go ahead, knock yourself out. But in terms of rental properties, buy a house that looks like the other houses around it. Okay, it's easier to comp, and it's easier to rent, and it's easier to sell. That you don't want to have an 1,800 square foot house when all the other houses around it are 1,100 square foot. You don't want to have a house built in 1930 when all the other houses around it were built in 1970. Okay, so if you like unique houses, do that for your own home, but for your rental portfolio, you'll be making your life easier if you just buy stuff that looks the same as everything else. What's next? So work with an experienced property manager. That's I think I've done entire podcasts just on property management. That's obviously, crucial. And check their references. Like, find references. Get, if you're talking to a manager, ask them to give you references of other investors, ideally investors that have a few properties with them, and pick up the phone and talk to them, or fire them a quick email. Also, what's next? Stay away from coastal locations if you're buying rental properties. Just too many insurance issues when you're near water, and just too many risks. Okay. What else? Avoid really old properties unless you're an expert. If you're an expert, do whatever you're an expert in. But for me, it's certainly a lot easier to renovate a house when it's built after the 1970s, because you're just not getting those expensive, complicated plumbing and electrical issues. And avoid timber homes too. Concrete's way more reliable. So if you're buying like a 1970s concrete home, you're avoiding a lot of the mistakes that trip up people. If you're like older homes, timber homes, they come with termite issues, wood rot, foundation issues, electrical, plumbing. I mean, some people buy an old house and just fix it up cosmetically and it looks great, but then they've forgotten about the $45,000 that they needed to spend replumbing it and rewiring it and fixing a bunch of foundation issues. So avoid that if you want an easy life. Just buy concrete homes that are built, 70s onwards. They're a lot easier to renovate because it's mostly cosmetic stuff that you need to do to make them as good as new again. And then what else? So final thought, try and become an expert in specific geographic areas, because it's a lot easier to scale that way. I mean, real estate should be part of a mix of asset types in your portfolio, right? So I'm not saying put all your money in real estate. I'm just saying try and become an expert in geographic areas. I mean, I think people get too hung up in diversification sometimes. They're buying 6 properties and they're all in different markets. I mean, that doesn't make much sense to me. I mean, it's easier, how would I phrase this? It's easier to watch one basket very carefully than to keep your eye on 5 or 6 at once. That's what I think. I mean, I've invested in a lot of different markets now, but I've kind of sold all the other stuff and pretty much focused on Tampa now, and I'm watching that basket, very carefully. So yeah, hope that was useful. Maybe it was a little bit rambly. I don't know, maybe not. But I wanted to talk about this stuff for a while. I have been talking about that theme to investors for the last few weeks now, and I wanted to get it on a podcast. So, hope you enjoyed it. Thanks again for tuning in. And I'll try and get a guest on the podcast soon. I haven't had a guest for a while, so I'm working on a few ideas for that. So yeah, stay tuned. Thanks for listening in. This is Colin Murphy signing out. You guys have a great day. This recording contains general information relating to the real estate market, and it is for educational purposes only. Buyers should always seek appropriate legal, tax, and financial advice from suitably qualified professionals before entering into any real estate transaction. Actual returns from rental properties will always vary from person to person and deal to deal based on unique circumstances. While we have no reason to doubt the validity of comments of any guests on our show, we do not warrant their accuracy. Opinions of the host are not necessarily shared by other employees and partners of Torcana and its subsidiaries.